All right, thank you very much, Alexander. In today's sort of short introduction here, I would like to talk about selected research on short selling. I think of it as a very vivid area of research. It has clear results, many policy implications. I also want to be clear that this is not my own research that I will present. I will sort of give a little bit of a review of the selected research papers, but I am an active follower of the research. Before highlighting some research results, I would like to go through the mechanics of short selling. The purpose is simply to refresh our knowledge and to cover some of the important details that will come up in the panel discussions afterwards. So on these slides, we have a very simple how the short selling works and the mechanism. And the goal from a short sale is then to benefit from a decline in the price of an asset. And the asset that we're going to talk about here will be a stock. And the mechanism here is actually very simple on this slide. It means that you, as a short seller, you borrow shares of the stock, you sell the shares, and later you buy back the shares, hopefully at a lower price, and then you return the shares to the lender. So this practice can be used for speculative purposes, just being short, or you can have it as part of a long-short strategy, or you can use it for hedging, as simple as that. Now, while this looks very simple, it actually involves two markets. One is sort of lending, borrowing the stock or the shares, and one is actually selling and buying the shares. It also involves several market participants, and I believe that the institutional complexity contributes to some of the regulatory challenges here. This were very simply described, but I would like to go into some of the details and consider them next. So here we have 4 boxes on the slide, but I will just very briefly mention them and then show another graph or another figure. So the first one is that you need to borrow the shares, then you need to sell the shares, but they also have relationships with your broker and the lender. And then there are other things that are, of course, important, but something that may be less of an issue for this discussion, and that is about voting rights and dividends. Maybe it will come up, let's see. So I would like to talk about these borrowing the shares, selling the shares, and the broker and lender relationships through this graph. So consider yourself being sort of the short seller here in the light blue box. And the first thing you need to do here, just remind us, we have an opening of the short position, that's the top panel, and then you have closing of the short position in the lower panel. So the light blue short seller here, he or she needs to borrow the shares and can go through his or her broker. And the broker can either locate the shares in an account of another client or go outside and find a lender of the shares. So the short seller have the relationship with the broker, the stock lender, and will then get the shares. And the short seller can then move to the market where he or she can sell the shares. And to get the cash will be together with some margin requirements to the broker, and the broker will put in collateral to the stock lender. So this is a very simple way of looking at it, but it also highlights some of the issues. Of course, for example, that the short seller needs to pay a fee to borrow the shares. And that fee can fluctuate a lot between different types of stocks, and it can also fluctuate over time once you even have a position going. The other thing is that the stock lender can ask to have a so-called recall to get back the shares, and the short seller have a few days typically to go to the market and buy them and return them, or ask the broker to help out with locating new shares that can be sort of shorted. Now, so there's recall risk, and there is fluctuating fees to consider. Now, when the short seller goes to the market, there are also some institutional details that are interesting to talk about. One is, which was at the debate around 2008, was a naked short sell, or covered versus uncovered short sell, meaning that if you have the shares, you have located the shares, you got them, you sold them, or you actually initiate the short without having the shares, or have initiated the borrowing of the shares. I would like to hear the panelists a little bit about that, but it seems to me that it disappeared a lot after the 2008 crisis. The other thing is when you can sell the shares, and there are different types of price rules, and there, for example, an uptick rule, which have been in place in the US from 1938 to 2007, which is about that you're not allowed to short a stock that has a falling price. You have to wait, so to speak, for an uptick, and then you can sell. That has been replaced in 2010 by different circuit breakers triggered, depending on how much the stock price falls and so on. And there are different sort of mechanisms or different rules at different markets. And I also would like to hear the panelists about this, because this has been in the recent debate. The final thing that I want to say about the graph is the short seller's relationship to the broker. And the short seller may face the risk that if the market moves against the short seller, he or she will be asked by the broker to actually increase the margin requirement, and that can sort of be the end of a trade or an end of the position. The other thing that needs to be said here is that if you have the open position over the day or to the next day, there will be sort of margin requirements that will be marked to market. The short closing of the position, of the short position, is basically the other way around. The short seller goes to the market and buys it from the seller, gets the shares and delivers them to the broker, and then returns them to the stock lender. That will be the closing of the short position. So with that, I would like to sort of go into some of the research involved in here, some of the risks and the challenges and opportunities that are in benefiting from the price decline of the stock. So I'll start by mentioning short selling in normal times. And for those of you that are as nerdy as I am, you have sort of at the very bottom here, you see some references, some research papers, articles that I can back up some of the statements here or the results. So on the first bullet, I would say that theoretical models, the simplest ones, they suggest that opinion divergence and short sale constraints lead to overpricing and slower price discovery. So there's a very simple story. Think about the market with optimistic and pessimistic investors. The optimists, they have positive information or positive opinions. The pessimists, they have negative information or negative opinions. And if short selling is not allowed, the optimists, they can obviously buy the stock. Pessimists, if they own the stock, they can sell it, but that's it. The negative information from the pessimists may not be reflected in the price. So the optimists will dominate and the price will be over some fundamental value. And also when there are news coming in, it may be that the price discovery will be slower. What about the empirical evidence on these predictions? Well, there are a number of articles showing that short selling activity or short selling costs, they predict lower returns going forward, both in individual stocks and in fact also on the market. It's one of the strongest predictors of market returns. This negative returns going after activity, it can be seen as sort of value relevant information being revealed in these short sales. The last bullet point here is also that short selling activity interacts with corporate events, and short selling activity tends to rise around negative fundamental events. And some of these events will be addressed by Alexander very soon. What about short selling during a crisis? We can ask the question if there's a potential justification for temporary short sell restrictions. In fact, recent theoretical models, they argue that financial institutions may be particularly vulnerable to predatory short sales. It could be, for example, that they are leverage constraints due to regulations, or that there are some risks for creditors and bank runs. These models predict that financials will be slightly different. Well, during the 2007-2009 crisis, which was the financial crisis, the global financial crisis, short sales were banned for a period. And what do we observe on the prices during the crisis? Well, we see deteriorated liquidity. It can be shown in higher bid-ask spreads, higher market impact, and other measures of liquidity. And so the deteriorated liquidities are for the banned stocks relative to the non-banned, but otherwise similar matched stocks. So that's on the liquidity. The other one is about whether prices are supported or not. And the evidence here is that no difference in returns between banned and non-banned stocks. That is, the ban did not prevent prices from falling. Now, how can we take a bearish position if there's a ban on a stock? Well, you may want to consider ETFs. You may want to consider credit default swaps. You may want to see other derivatives. And so the derivatives market is closely related to the markets for the underlying and impediments in the for short sales. And typically you see higher spreads and higher prices as measured by implied volatilities when there is short selling costs. You also see violations of many of the arbitrage relationships, such as the put-call parity. And during the 2008 short selling ban, there were a dramatic deterioration in liquidity of options on banned stocks and significant put-call parity violations. Now, this is not only for speculation, this can also be for hedging. Suppose that you have issued a put option and you want to hedge that by shorting the underlying stock, and you can't do that, then that leads to worse prices and bid-ask spreads, higher bid-ask spreads, and violations of different parities. So this is what happened in the 2008 short selling ban. And I just want to raise an issue related to ETFs, and I'm very curious about what the panelists may think about this. ETFs were a relatively small part of the market in 2008. Now it's a global market with more than $6 trillion under investment. And the question is how important, say, short selling opportunities or how severe impediments are for this market to keep the price of the ETF equal to the net asset value of the underlying securities in the ETF. And potentially it can hurt this. What I want to say with this is basically that short selling bans may have effect on other markets and other situations, and even for different stock or the same stocks traded in different locations. I stop by this. Just want to say that academic research supports the view that short selling helps the market to correct for price deviations. We have seen evidence of overpricing, slower price discovery, and we see spillovers to other important financial markets. And I'll stop here and hand it over to Alexander.
All right, so hopefully you can see my screen. Here we go. So thanks, Magnus. Before we turn to the panel discussion, I'd like to briefly introduce you to a particular type of short selling strategy, one that I think fulfills an important function in capital markets, but is also very controversial, something that I like calling activist short selling. If you've been following the financial news recently, as I'm sure you have, you're in fact already familiar with the handiwork of activist short sellers. And that's because they've helped uncover two very recent frauds, or maybe I should say alleged frauds, which no doubt you have read about. The first concerns this company here, Luckin Coffee, which is a Chinese competitor to Starbucks. Luckin started out as a startup, quickly became a unicorn, and then went public not in China, but on a US exchange in May of last year, with great fanfare, as you can see on the picture, where the company was allowed to not open the market by sounding the opening bell, but sounding the opening gong, which seems appropriate given the China connection. Only 8 months after the IPO, Muddy Waters, one of these activist short sellers, tweeted the following: Muddy Waters is short Luckin. We received unattributed 89-page report alleging Luckin is a fraud, followed by some statistics backing up that claim, and a link to this 89-page report. Perhaps not surprisingly, the company first denied the allegations, but admitted in early April that around half of its 2019 revenue was fabricated, and fired the CEO, amongst others. NASDAQ, where the company was listed, then suspended trading and initiated proceedings to delist Luckin. Luckin initially appealed, but only last week withdrew its appeal, and now the delisting is going ahead. The other company is another unicorn, in this case a German fintech company that I'm sure you've read about, can't escape it these days, namely Wirecard. Wirecard entered insolvency proceedings only last Thursday after admitting that 1.9 billion euros had gone missing, and in fact may never have existed in the first place. And in this case, too, short sellers were involved in blowing the whistle. I first became aware of potential problems at Wirecard in early 2016 when I saw this report by an outfit I had not previously heard of, Zatara Research. Now, in this case, it took 4 more years rather than just a few months for the fraud to unravel, amid denials from Wirecard and allegations of dirty tricks played against both short sellers and investigative journalists. If you haven't read about it, it's fun to read, somewhat scary. Now, Luckin and Wirecard give me a certain sense of déjà vu. 9 years ago, in 2011, I joined the NASDAQ Listing Council in New York. Now, the Listing Council advises NASDAQ's board of directors on matters of listings and securities regulation and so on. And I joined the council just at the time as US exchanges were being hit by a tsunami, if you like, of activist short selling, directed above all at Chinese companies that had listed in the US, so not unlike Luckin. My work on the Listing Council brought me in contact with this breed of short sellers, these activist short sellers, who earn a living from uncovering deception in the markets, as the book title in the middle by Manuel Asensio puts it. Their work intrigued me greatly as an economist, and putting my academic hat on, I began a study of the economics of activist short selling, which was published a few years later. And here's what I learned. The activist short sellers playbook goes something like this. They try to find companies that are overvalued, and they do so in a very hands-on way, and I'll illustrate that for you in a moment. Then they quietly take a short position in the target stock in the hope that the target stock price will fall. And so far, so very normal. But then they do something that's more unusual, and that caught my attention. They reveal the information to the market. It's a bit like that tweet by Muddy Waters that I showed you a moment ago. To raise the question, why reveal the information? Now, it turns out that most of these activist short sellers are price takers, in the sense that their short positions are individually too small to move prices. Part of the reason their short positions are typically small is that their targets are unusually expensive to short. These are companies that are either very small or they're very popular, and it's difficult to borrow the stock, as Magnus was explaining to us. It's expensive. And in fact, the targets that we looked at in our research are among the top quartile hardest stocks to short in the US market at that time. Which raises the question, how do you correct the mispricing if not through actually shorting the stock and driving the price down that way? And the answer is, as we discovered, by persuading the long side of the market to sell. The longs don't face these expensive short sell constraints. They don't have to go and borrow stock. They have the stock. All they need to do is to call up the broker and sell it. Now, for this strategy to work, it's critical that the information that the short sellers reveal to the market is credible. Otherwise, the longs will simply ignore it and the price will not fall and the short sellers won't make money. Now, let me give you a sense of what active short sellers are up against. Their challenge, as I mentioned, is to be credible. In order to be credible, they attempt to uncover scoops, often with the help of on-the-ground, literally, detective work. And here's an example of what that might involve. To quote from a report on a Chinese company, we have surveillance efforts being costly and difficult to conduct under very threatening conditions, says the short seller, where their field agents must first spend a few weeks watching the company, and several of the local operatives have been detained, questioned, and beaten by company security. I even know of cases where these local operatives have been arrested by police and face trial in court in countries where it might not be so comfortable to be in prison. And many short sellers go to extraordinary lengths to be credible. Here are a couple of stills from surveillance videos filmed by a particular short seller over the course of 4 months in an effort to reconcile a company's claimed turnover against truck movements in and out of its main factory. So you can see it's very detailed, hands-on kind of investigative work. Now, activist short sellers like to claim that theirs is a risky business, and not just because investigators are sometimes beaten up or detained. They also run the risk of being sued by their targets or being investigated by regulators for market manipulation. Wirecard would be an example where the German regulator went after the short sellers. And there are even allegations of dirty tricks. In Wirecard's case, it's alleged that short sellers suffered coordinated and very professional cyber attacks out of India and were followed around by security companies that were hired by Wirecard's law firm. So that brings me to this piece of research of mine. My co-author, Wenlan Chen, and I studied 124 short-selling campaigns between 2006 and 2011. And these were all targets that were listed in the US, but half of them came from China, so 50-50 China-US companies. The first question we asked was, what happens to share prices when short sellers disclose their information? And the answer is, share prices fell on average. Perhaps we expected that after reading a few hundred of these very lurid reports with videos and photos and so on. But what surprised us was how quickly prices fell. Here's high-frequency data over the 8 trading hours before and after the release of a short sellers report, indicated by this vertical line here. Price changes hover around 0 before the release, but once the report is released, they take only something like 2 hours or so to fall by 12% on average, which suggests that investors appear to be paying attention to the short sellers' reports. However, the price adjustment is not complete over the report day. Prices continue to fall over the next quarter. Here I'm showing you cumulative price changes over the next 60 trading days, 3 months. And over that time frame, prices fall by an average of 28% net of market movements. 12% on the first day, and then another 16% or so over the next 3 months. Now, the following slide will, I hope, convince you that the trigger for these price falls is the disclosure of the short seller's information and not something else happening in the market. And that's because we see volatility spiking. On the day a short seller releases a report, volatility increases by more than 250% on average, relative to what's normal for these target companies. There we go. Sorry. There we go, 250%. Now, this increase in volatility coincides precisely with the release of the information. The increase is relatively short-lived, returning to normal within about a week. So there is amplified volatility, but only for a short period of time. Now, the increase in volatility reflects a tremendous increase in trading volume. On the report day, share turnover is around 340% higher than normal and remains elevated for around a month or so. So short sellers put out the reports, and there's a lot of trading in response. Now, the spike in trading is not coming from the short side, and I think this is very important and very interesting. In fact, shorting activity is, if anything, a little below normal for these stocks once reports are out. The only mini spike in this graph here is on the day before the report is released, when shorts are at about 50% higher than normal. Now, we can't prove this, but a reasonable guess seems to be that the short sellers are increasing their short position just before disclosing their information to the market. I think this chart begs an important question. If the reports that the short sellers put out are so credible, why don't other investors start shorting the targets once the reports are out? The reason is the shorting costs balloon. Now, I mentioned earlier that they were already high to begin with. They're in the top quartile for these stocks, but they only get higher still. They're up by 50% on the report day, and then up by another 200% over the quarter. So these lending fees that Magnus was talking about, they increase by a lot. So it's very expensive to short these stocks, both before and especially after a short seller's report is released. And yet, prices fall. Why do prices fall? Well, prices fall because the longs sell. Here's the trading activity on the long side of the market. On the report day, trading on the long side increases by more than 500%. Now that's both buying and selling, but our data allows us to zoom in on the selling activity of target companies' institutional shareholders. We don't have data for retail. When you look at these institutional shareholders that own the target company stock before the reports come out, we see that most of them sell, and they sell a lot. In fact, around half of the institutional investors with a long position in target stock as of the day before the report is released sell over the course of the report day. And not only do most institutional shareholders sell, they sell a lot. They sell nearly half of the shares they owned on the report day. Well, just let that sink in for a moment. It is the long side of the market whose selling is causing target firm prices to fall. Now, at this point, you might still be concerned that active short sellers are making false claims and misleading the market, and these pretty videos and so on are just obfuscation. But at least for our 124 short sell campaigns, it looks like the short sellers' claims are largely true. In more than 80% of cases, investigations by regulators, the FBI, police investigations, stock exchanges, etc., come to very similar conclusions as the short sellers. And when we wrote our paper at that time, 40% of targets had been delisted on public interest grounds, which is the way you get rid of undesirable companies that are not good for investors. The company's own actions indirectly support the short sellers' claims in our sample. Nearly 80% fire senior management, a third replace the auditor, usually because the auditors resign, and a quarter end up restating their earnings, again, as of the time you wrote the paper. So, to conclude, activist short sellers engage in a strategy where they go after companies that are overvalued because of fraud, aggressive accounting, and dubious business practices. They help correct mispricing, which aids in price discovery in the markets. And the way they do so is by persuading the long side of the market to sell, which I didn't know before. I don't think it's a coincidence if we're seeing frauds being uncovered by active short sellers right now. Falling markets tend to reveal frauds. And as Warren Buffett put it, much more eloquently, only when the tide goes out do you discover who's been swimming naked. Now we have a lot of companies swimming naked. So at least for the short sell campaigns that we studied in our research, I think it's fair to say that the activist short sellers were several steps ahead of the authorities, regulators, exchanges, and so on. And I also think it's fair to say that the short sellers helped the authorities clean up what I think of as the gutters of the financial markets. And I'll end, before I hand over to Magnus, and perhaps provocatively, with a claim that activist short sellers of the type that I've described provide an important public service for private profit. Thank you.
All right, thank you very much, Alexander. So after these two short presentations, we will open up for a panel discussion. And we will also open up for questions from the audience. The attendees, you can use the Q&A in Zoom to pose questions, and I will keep an eye on the Q&A box. And if there's any interesting questions coming up during the discussion, I may bring them in. Otherwise, I will try to ask the questions for the attendee at the end of the session. With that, I think I'll let John start by responding both to Alexander and mine presentations, but also gives his thoughts on the issues. Please, John.
Thank you. It is good to be back in Stockholm, even if only virtually. This is the season to be there. Now, our Swedish hosts have painted a picture of contemporary short selling as benign, socially desirable, and essential to accurate stock pricing. In effect, the short seller is a kind of hero of the efficient market who should be commended, maybe given a medal, but not closely regulated. Basically, I probably agree with that assessment 75% of the time. But it's the other 25% that are particularly interesting and haven't yet been much focused on. Short sellers do play a critical role, and some of them have been heroes, such as the famous Mr. Chanos, who was the first to put pressure on Enron and the first to, over a long time, which he took incredible risks, eventually convinced journalists and everyone else that Enron was a house of cards. Okay, that's the good side. But I also recognize that short sellers can be abusive and can sow misinformation. The difference between myself and my colleagues may be a characteristic difference between economic professors and law professors. A practice can be generally desirable and be applauded by the economists, but still has problems on which law professors with their petty mentality tend to focus, okay? For example, this is an analogy. Driving on public roads is benign, necessary, and essential to the economy so that workers can get to work, okay? But that does not mean that there should not be sanctions directed at drunken driving and reckless speeding. And indeed, we require driver's licenses, we require exams, maybe even a driving exam. All of those things are necessary to protect the public. So there may be occasions when short selling does become abusive. Let me describe a somewhat different pattern that characterizes the United States today. A key fact about short selling campaigns by activist short sellers is that many of these activist short sellers, probably a plurality, remain pseudonymous. That is, the short seller uses a pseudonym and its personal identity remains unknown to the market. Let's give an illustration. Suppose I adopt the nom de plume of Sherlock Holmes. I'm hoping that Sherlock Holmes is known in Scandinavia as well as in Britain. And I announce on various websites that are specially favored by short sellers that I am on the case and will be examining a hypothetical company, XYZ Corp, and I accuse it of prematurely recognizing over $1 billion in revenues that are highly dubious and may never occur. I present a report that has some plausible supporting evidence, and the stock price on the day of that report's publication falls 20% from $10 to $8 per share, and 100 million shares trade on that day. In fact, in the recent short attack on GE, 400 million shares traded on the date the report came out from the short seller. Now, 2 days later, and it usually is a period later, the company responds. They have to talk to their accountants, they have to get their act together, they have to make sure they're not saying anything that the SEC will challenge or litigate, okay? 2 days later, the company responds, rebutting this attack in detail, and the market now rises back from $8 to $10.10. In other words, a small profit, and it remains stable thereafter. Nonetheless, 200 million shares were sold on Monday and Tuesday at a price well below $10, meaning public investors took a loss when the stock wholly rebounds. Worse yet, a follow-up investigation discovers that Sherlock Holmes actually closed his short position out on Monday night or Tuesday morning and went long on that day, possibly expecting there'd be a price recovery when the corporation published its defense. Now, is such a case rare, unique, or even atypical? My colleague, Professor Joshua Mitz, who's a professor of finance, PhD in finance, has identified in his paper Short and Distort some 1,720 pseudonymous attacks made from 2010 to 2017, his research period. And these were made all on mid and large cap stocks. He wasn't looking at small companies. He found over 20 billion in net mispricing in that study of a stock that fell and then rebounded. That is the pattern that I am most concerned about, a pattern of a sharp price reversal with the stock going down significantly on the short seller's attack and then rebounding a few days later. And that may be related to the use of a pseudonym. Why? There is little reputational loss when a pseudonym is used. The short seller, if he bungles it, can give up on the identity of Sherlock Holmes and adopt a new name, let's say Private Eye. And if this new name can make a couple of successful short recommendations to the market, it gains some reputation, and maybe now it can lead another real attack where it invests its own money trying to drive the stock down, even though the stock stays down only for a day or two because it ends its position and it may hedge or cover or even go quite long expecting a rebound. Now, many of you may say, well, you have to be careful here because if you say anything fraudulent, that's illegal in the United States. Yes, it is. But under US law and under the common law, statements of opinion are not considered to be fraudulent unless you can actually show that the speaker did not truly believe, did not subjectively believe the statement it was making. That's a very high standard of proof, to prove that someone didn't believe what he was saying. Okay, and against that backdrop where the law of fraud gives only a weak remedy, what kind of reforms make sense? Now, first of all, you might say, well, we should prefer the least drastic means, and that's my essential point. We should always choose the least drastic means in this context, and the least drastic alternative should be favored because, as I strongly acknowledge, short selling is needed to curb the fairly strong sell-side bias of brokers and other financial institutions, okay? Now, one feasible reform might be to seek to preclude the use of pseudonyms. But in the United States, that would probably violate our First Amendment, which does protect anonymous speech and wouldn't let you, in a blanket fashion, prohibit anonymous speech. In other countries that aren't crippled by our First Amendment, you might want to consider blocking the use of pseudonyms. Alternatively, another reform, one that my colleague Professor Mitz favors, would be to require minimum holding periods for the short seller. You'd have to hold the position for 1 week, 2 weeks, or a month, whatever period you want to say, so that you could not profit truly if the stock went down for 2 days and then reverted to its old price. That might be an interesting reform, but I believe it's probably beyond the current authority of the SEC, absent special legislation. And it also would probably offend my least drastic means principle. My own preference for the least drastic means leads me to favor two rules. One, a requirement of very prompt disclosure within hours when the short seller closes out his position, and legal recognition of what is called scalping theory, which is present in our cases. And it says that if you buy or sell a large position, knowing that you're going to reverse that position imminently a day later, you have to make a disclosure of what your intent is, that you're going to change this position. Otherwise, you're making a material misstatement when you fail to disclose this as a very temporary position. So prompt disclosure, disclose when you close out the short position, recommendation one. Two, and more important, I think we should make more aggressive use of individual circuit breakers. Individual circuit breakers. By that I mean, if the individual stock, XYZ Corp, falls more than 10% during the trading day, short selling would be barred for the remainder of that day, and that day only. You could go short again to the extent of 10% the next day. The point at which this circuit breaker should kick in could also be related to the level of volatility in the market. There are certainly indexes, the VIX index and others, and in a pandemic with great volatility, maybe the securities regulator would reduce the circuit breaker from 10% price fall to an 8% or a 7%. That, to my mind, is certainly better than trying to ban all short selling on a particular class of stocks. Now, the circuit breaker approach has the advantage that it allows the short seller to profit, but limits how long he can seek to press the stock down on a given day. The individual stock could still fall 50% or more, but that fall would be driven by the longs who are believing the short seller and are closing out, selling off their position. We wouldn't allow the short seller to get more than 10% a day, and that would reduce the incentive to make a very short-term gain that you know wouldn't persist for more than several days. Now, in conclusion, because I want to be brief, let me conclude with one last thought. The case for short selling and the amount of regulation that is desirable may properly depend to some degree on the level of transparency in the market. Muddy Waters, which you've already heard about, which is primarily a Chinese short seller, although it was founded by Americans, Persson, has a very interesting name. I originally thought it was named after a very famous American blues singer called Muddy Waters, but it's actually named for a famous Chinese proverb. And the Chinese proverb says, quote, "You catch the most fish in muddy waters." Indeed you do. The Chinese securities markets are today the Wild West of the 1870s in the United States. They are uniquely opaque, and there are strange actors active in that market, okay? And then the Chinese system has far less enforcement resources, both public and private, to combat securities fraud than does the US or probably Europe as well. The US market has a number of weapons: criminal prosecutions for securities fraud, securities class actions, greater enforcement resources, and sometimes, although rarely, even our auditors catch something. What we really learned is auditors don't do much in these recent scandals. Okay, in a more transparent market, such as the US market, we are less dependent on the short seller. He's less indispensable. And I think a certain, somewhat greater degree of regulation is appropriate, given that we have a variety of fail-safe remedies. In the Chinese market, it may be the only thing that protects investors is the short seller, but that's a context that I think deserves distinction, and I'll let the rest of the panel discuss that possibility. Thank you, and I think I've stayed close to my 10 minutes. Okay.
All right, thank you very much, John. I took two keywords here from your speech here about the disclosures and circuit breakers. And I'll give Alexander an opportunity to briefly respond, but then I would like to go on to the other panelists as well.
I'm very curious to hear what the other panelists have to say, but there's perhaps one thing that is worth mentioning up front. I completely agree with John that the use of pseudonyms, that feels fishy. But there's a really important angle to this. And I highlighted the importance of credibility for the way that these activist short sellers actually drive down share prices. They need to be credible, or else the market won't pay attention. And in our research, we looked at whether it is the credible short sellers, the ones who've established a reputation for being accurate in their claims, who manage to pull off the trick of driving the share price down by inducing the longs to sell, or whether that feat can be replicated by others. We very strongly find evidence that you have to have a reputation for being credible when you make claims about companies, or else the strategy will not work. So I think the market is self-regulating here. People who are paying attention to the short sellers are also paying attention to the short sellers' history of being right, and take that into account when they respond. But with that, let's hand over to the other panelists.
All right. With that, I thought maybe Scott, you would like to sort of touch upon various things that both I and later John were talking about.
Okay, wonderful. You just came back, so hopefully my internet's going to survive this. So thank you for turning it over to me. And just by way of background, I was an academic who took a leave of absence in 2007 to go to the Securities and Exchange Commission, predominantly to get institutional knowledge on my research program. And it was somewhat coincidental in that I was there when the financial crisis hit. And while market structure was not my area of expertise, like many economists there at the time, I was forced to learn a little bit about it because it overtook and consumed the agency during 2008. And it really shaped my view quite a bit on short selling. And it was on September 18th of 2008, the day before, the SEC implemented an order banning short selling in financial stocks, that a lot of activity happened at the SEC. And in particular, on that day, a number of economists sat down with then Chairman Chris Cox to talk about the implications of what might happen if there was a short sell ban. There's a lot of activity, just like there was in the recent coronavirus crisis, on we need to do something to protect markets and investors. After that meeting, which we thought the economists had successfully convinced the chairman that banning short selling would have a lot of unintended consequences, that the chairman also got a call from the Treasury Secretary and the UK FSA, who was the Financial Security Authority that no longer exists in the UK, wanted to ban short selling of financial stocks. And indeed, that night, the order went out. And it's interesting that in times of crises, one thing that universally happens, which is somewhat odd, is that CEOs and politicians all seem to agree that they prefer prices to go up and down, and will take any measure to ensure that that happens. And short selling bans tend to, are believed to reduce selling pressure. So the next day, on September 19th, when we all came back to the office, there were a line of black cars on F Street in front of the SEC building. And these were all of the market participants from New York who had come down to explain all of the problems that were developing in financial markets. And they were all put into conference rooms. Every conference room of the SEC was filled with different groups. And when I got in, I was assigned the conference room on the 4th floor. And they said, this is where you go. There are a bunch of people that want to talk. And another assistant director in a trade and markets group joined me. And it happened to be the Citadel group. That was back when Citadel was just a hedge fund and not quite so prominent, not a big securities dealer. And over the course of the next hour, I got a very quick education into all the consequences of banning the short sale financial stocks. And the one which was most problematic was that up until then, the 9 months leading until then, financial stocks, the predominant way for them to raise capital, which they need a lot of capital, was through the issuance of convertible bonds. They were not healthy enough to issue straight debt. The market would not take an equity issuance, and convertible bonds, which are bonds that are convertible into equity securities, which is a specialty of convertible bond hedge funds, was the only way to raise capital. But the way that a hedge fund purchases those convertible bonds is through the ability to short sell the underlying stock when stock prices go up to hedge out the equity risk. And as soon as there was a ban on short selling financial stocks, no more convertible bonds could be issued, which means that the last source of capital, the banks, was turned off. And I think it was another 9 months or longer before the next issue was made. Now, we don't get to see the counterfactual of what would have happened if the short sale ban had not been implemented. And maybe it's also true that banks couldn't have raised capital to these issuances thereafter. But it is true that it didn't occur after the 19th, and all those that were in process at that time were suspended. So that was one of the most prominent side effects or unintended consequences of the short sale ban. And thereafter, in the next several months, a lot of experiments were run at the SEC to understand the consequences, some of which Magnus has pointed out in terms of the interpretation of the short sale ban. And there's not a lot of favorable news that came out of those studies. There was some mild evidence that there was a reduction in downward pressure, selling pressure on some of the securities, but it came at a very large cost to the market efficiency overall. I would sum up as my view on short selling. And I'll add, Professor Coffee made a lot of very nice comments about what to do in certain cases. And what I'd like to point out is that these certain cases tend to be around market crises. You don't see a lot of clamor to reduce short selling during normal times, and the muddy waters of the world seem to be the good players, during normal times. It's only when you have a crisis, when politicians, regulators, and CEOs of corporations say we need to do something about this, and that's where I think there's a lot of confusion on what short selling ban does versus other measures. And I do think circuit breakers, as Professor Coffee has pointed out, have been a far better way to modulate volatility during crises. And there was a test in 2015 of the new rules, circuit breaker rules, when there was a volatility event that proved the circuit breakers worked really well, with some caveats on reopening securities, and those rules were modified. And if you look at the coronavirus and the market volatility that ensued, circuit breakers have worked particularly well across the board. And the uptick rule, which was mentioned by you, Magnus, on preventing short selling when there's a downtick or selling pressure and you have to wait for an uptick before you can short, those were removed in the US in 2007 because in some respects, they're like those little speed bumps that are in front of stop signs. They warn a driver that, hey, you may need to stop in the next few hundred feet or 100 meters, so get ready. But the uptick rule was like having those little speed bumps on every single street, and they were an annoyance and a nuisance. And imagine driving downtown where every 100 meters you went over speed bumps for no particular reason. And so the alternative uptick rule that exists today is a combination of when there's downward pressure and a price drop of, say, 10%, then those those rules kick in. And so maybe there's some scope for revisiting when to put those speed bumps back in. As Professor Coffee was suggesting, maybe there's some scope to create some price test rules. But overall, I don't think there's a lot of view amongst economists that putting more price test rules in or would be particularly efficient during market times. I'll just close by saying that I didn't, if you'd asked me in February or early March when the coronavirus was unfolding whether or not the SEC would not put in any short sale ban, I think it would be 50-50. I was quite surprised that nothing actually was done. And I think that's good news in the sense that we got to observe the full unraveling of how markets reacted without a market intervention. I think there will be a lot of studies that will take place going forward, comparing across markets, particularly those markets that did put in those tests and securities that span those markets and other markets. So let me just pause there and turn it back over to you, Magnus.
All right, thanks, Scott. I thought it was super interesting to hear about the SEC and how it sort of developed over time. But I also thought that maybe we can get sort of a more of a European perspective and also perspective on other exchanges in the world. So with that, I would ask Pedro to join us on this.
Sure, thank you, Magnus. So I mean, in general, I will agree with Scott's position on the question on other markets. Well, it's interesting to think about what happened in 2008 when there were around 20 countries imposing bans on short selling, and what we saw happening during the recent COVID-19 events, where it was around 10 markets that imposed those restrictions. We know that there were 5 European markets that decided to go with these bans, and interestingly, there was not a unified approach, which reveals that there is some the different positions in terms of the benefits of those bans. We also have Istanbul, Malaysia, Turkey, South Korea and Indonesia that imposed short selling bans. So it was what we can take out of this is that there has been some learning experience after the 2008 crisis, and the experience has been, the lesson learned is that I guess that short selling bans are more harmful than beneficial. It's interesting that Scott mentioned the SEC, and it's well known the comment that Chairman Cox, the former chairman of the SEC, made about his regret of the decision on short selling bans. If we look around the different countries and regulators, you see that there has been an interesting change of position. So the FCA, for example, in the UK, which was one of the regulators that at that time the FSA imposed a short selling ban in 2008. This time it came with a completely different position and was very vocal in terms of saying that there was no proven benefit on a short selling ban, and also that the short selling was really a small amount of the market, so they didn't see any risk on that activity. Other regulators, of course, have taken a different position, in particular the US and Germany, for example. And at the end, it seems that there has been some learning in terms of what is the potential benefit and what are the costs of short selling bans, and the outcome has been that in many of these countries there has been some change of the way bans are seen. I would like to highlight some things that I think are relevant. Is that there's an ethical component here that tends to be ignored, and which in many cases I think drives some of these short selling bans. This idea that short sellers are benefiting from the misery of others, and it's interesting that this is linked to something that Scott also mentioned, which is that it's in many cases the short selling ban looks more like a political kind of action rather than a real justified measure to limit volatility. And I also agree that the circuit breakers have proved to be a much more effective tool that keep the market functioning orderly without distorting the price formation process.
All right, thank you, Pedro. I'll let John respond. I'm also curious about sort of some of the, when it comes to disclosure or transparency in reporting, it seemed to me that the European Union were early on this in 2012. So if anyone has a view on that and how to sort of improve things, please. But first, John.
Okay. First of all, notice the degree of consensus. No one here is advocating a ban on short selling. And that's useful when you have a debate and one position is taken by no one. There are countries, and France has not liked short selling since the Code de Napoleon hundreds of years ago, and they may persist in that position. But elsewhere, the value of short selling, I think, is coming into increasing recognition and respect. Now, Alex made a comment in response to me that maybe I was given insufficient weight to the role of reputation. You have to have a reputation to be a truly credible short seller who can move the market. This is correct, but it's a little bit more nuanced than I think he explained. First of all, you can borrow reputation. The short seller behind the Luckin Coffee episode was a Chinese short seller called Snow Lake, and they gave their report to a number of short sellers, and Muddy Waters picked it up and ran with it. So Muddy Waters supplied the reputation, whereas Snow Lake got the information and did the investigation. That worked. In using pseudonyms, you don't just adopt a pseudonym. You spend a lot of time on the short selling websites making a number of recommendations that you research. Only after you made a number of recommendations and seem to have called them right a number of times do you get the credibility that you can now make a major campaign and put your own money in a substantial way behind your short sale position. But the advantage of using a pseudonym is if you are wrong and you blow it, you are not wiped out. You merely have to change the name you use and again start over by making intelligent recommendations and get some following. You don't get a permanent loss. And I do think there is a problem when you don't really have a sufficient stake in this because you've been able to avoid the downside of reputational loss. Again, I think the other thing we should note when we talk about short selling is it's changed in one other respect. Not only are people using pseudonyms, but the short sellers are finding ways to borrow substantial voting rights. The Wall Street Journal had a story within the last 2 weeks about a major short selling attack on one American company where 45% of the stock was owned by the big three of American diversified investors. That's BlackRock, State Street, and Vanguard. They had 45% of the stock of this company. They only voted at a key election 5%. Why? They had lent their shares to the short sellers, and the short sellers wanted to vote that stock and made sure that they were being able to hold the stock over the period of the election. And that's a little funny. If you can own stock and vote the stock based on what's only going to be a 2-week holding period and you don't have to buy the stock, we're letting voting rights follow a very short-term holder. That's been criticized by some, and I think it deserves some closer examination. You can also get your policy implemented if you had, in this case, they had something like 40% of the stock in short sellers based on borrowing it. To be sure, you have to pay a lot to borrow, but if you can borrow and get the voting rights, you're going to be able to influence elections. And the big three had no impact at all, even though they are the largest shareholders in the United States. So I just mentioned there's some further depth to all this that I think should also be explored. I turn it back over to you.
Thank you, John. I'll leave the word to Scott, and you want to respond.
Yeah, I've got 2 quick comments. One on the big three diversified investors that lend their stock to others to sell. I think it's interesting that if you look at the zero commission trading that many retail investors benefit from today and the costs of participating in markets, a lot, if not most of that, is due precisely because institutional investors now have profit models from lending their shares that make up for the loss in commission. So there's a huge shift in how investors participate in market that is, I think, at least somewhat connected to a lot of what we're talking about today. And so again, there's trade-offs and decisions in how you set up a regulatory structure. And this is one of them, is a positive externality from that environment. The other is in terms of what Professor Coffee has discussed in terms of transparency and disclosure, it's very reminiscent of an event that I did with him back in 2011 on 13D and G reporting, which is when an activist investor comes in and takes a position. You know, when do they disclose that position? And that's been under debate for a very long time. There's been rulemaking petitions to change that, to shorten the reporting delay. And my view there is simply, it's like putting a rock in a stream. It may change what it looks like. The water's still going to flow. And, you know, there are trade-offs to doing that. But one important economic consideration is that it will change the incentives of information collection, whether it's an active investor taking a position to make a difference in a firm or a short seller looking to profit from an overvalued security. How you set your transparency rules will set their ability to will limit their ability or to profit, which could encourage their incentive to collect information. I don't know what the right answer is on what those thresholds are. And maybe it's an empirical question where if you have different thresholds in different markets or in the same market, it might reveal some information. But it is a very interesting point that I think deserves continued attention.
All right. Anyone else that want to follow up on that? Pedro, please.
Yes, following on the presentation of John, I also had a question, because some of the things that you mentioned, John, have to do with market manipulation, which is not necessarily something that is exclusive for short selling, but it's in general something that it's we can see as a delictive behavior. So to what extent the cases that you're referring to are more a question of stopping market manipulation rather than stopping short selling?
Okay, if I can respond, are you hearing me? Okay.
Yeah.
I agree that short selling does overlap heavily with market manipulation. Market manipulation is almost impossible to prove because you have to prove that the person didn't believe his own statements. And even statements that seem rash can be sincerely believed, and you have to show real insincerity before you can prove market manipulation. Therefore, you need a second best way of proof. And I think creating incentives that encourage the short seller, may even demand that the short seller hold for some minimum period. Now, my colleague, Professor Mitz, wants to have the short seller be required to hold for a month or more. That's costly, but that would be one way that you would not be seeking to profit from the quick price reversal. You know, even in an efficient market, the market will respond to false information. A very credible but false report will drive the market down. And if you can sell 1-2 days later, you can profit before the company can make a credible, plausible response. So if we had either minimum holding periods, which I do not think is within the current authority of the SEC, or some other rules, such as requiring immediate disclosure of when you close out your short position, I think we come up with a practical, more feasible substitute for our inability to prove market manipulation in most cases.
Yes. So 4 days ago, for example, Borussia Malaysia extended its short selling ban. So in these cases where the short selling bans are not linked to, or not apparently linked to concerns of the type that we've been discussing on market manipulation issues, but they're more linked to this kind of intention of trying to limit market volatility to or the falling of prices by banning short selling. Exchanges where there is a strong political charge in these decisions. So in these cases, would you agree that it's a different type of problem, John?
Well, everything is a little bit different, but I do think that the most profitable examples of short selling recently have been short sellers who have developed and invested heavily in acquiring information. Whether it was they followed Luckin Coffee for months before the original short seller, Snow Lake, published its very detailed report and gave it to Muddy Waters. Similar in Wirecard, it took a lot of investigation before you could show that. And I think we want to encourage investment in negative research and finding out that the company is cheating, but we don't want you to be able to profit just on the charge without having to bear the cost of there being a rebuttal and the stock popping back up. That's what happened in GE, and something like 500 million or more dollars were lost by investors when the stock fell something like 30% in 1 month, only to pop up back to the original position a month later. And it was a long, complicated accounting debate. And the person who published the report was being paid on a contingency fee basis by the short sellers. They offered him some percentage of their gains. So if we could encourage either a longer holding period or immediate disclosure when you close out your position, I think we will reduce the incentive to make this attack aiming to make a profit just on the first day or two.
I'd like to jump in here with actually a question for John from the audience. Hans Wallin, he asks, Professor Coffee's story can easily be reversed, i.e. about the false dissemination about alleged good news. So is the story about short selling or is it about fraudulent behavior? And we touched upon it, but maybe you can clarify.
Well, I think the short seller wants to put out information. You can't just assume the market's going to eventually fall because it's very costly to hold a short position over a sustained period. So I think most short sellers are going short and then publishing their negative report. And to the extent that that may misinform the market, yes, there's an incentive to say it in the most dramatic fashion possible. In the recent attack on GE, the short seller, Harry Markopoulos, captioned the report with huge headlines, "A bigger scandal than Enron." Now, GE was not a bigger scandal than Enron, and its stock came back. But that impact of that kind of language, a bigger scandal than Enron, did send the stock of GE, a very well-capitalized company, down 20% when the market as a whole was going up last year. And I think that's an example of they really want to have the maximum impact with their research report.
Seems to be an interesting topic for the audience. So I have a second question for you, actually, which says, should the short sellers that are revealing negative information be held responsible in any way if the mention is not correct, and how should that be done then?
If you make a false statement in connection with the purchase or sale, or a statement intended and likely to cause purchase or sales, you can be held liable. But you have to prove scienter. You have to prove there was a true intent to make a false or a recklessly under-researched statement. Most of these studies have involved a good deal of investigation. And while you may overstate, you can usually state in terms of your opinion. My opinion is your accounting is hopelessly bad. Well, that's a statement of opinion, and there can be a debate. There is little litigation liability in those kinds of cases, although short sellers do get sued, but it's simply treated as a cost of doing business.
I would say there are three different types of cases that are worth distinguishing here. You've got the disreputable short seller, who's playing the kind of game that John was describing, trying to drive the share price down in order to then make money on the rebound. And then you've got the reputable short sellers, who are often right, at least in our research, and sometimes wrong. But of course, when they're wrong, maybe they get penalized, maybe they don't get penalized by existing laws, regulations, and so on. But if they're wrong too many times, then the biggest cost to them is that they begin to lose their reputation. They can't have market impact. This is an essential ingredient in their strategy. They need the reputation, or else they don't get market impact. So I think the short sellers are very conscious of the value of their reputation. When you look at their websites, they make a point of putting their track record, their history of being right and sometimes wrong, on the web pages, so that others who want to jump on the trade, or the long side who's listening to what they have to say, can judge for themselves whether this is reputationally sensible or whether it's somebody who's trying to manipulate the market. So I think there is a feedback mechanism from bad behavior to the value of future activity by the short seller that works through the reputation, even if perhaps current regulations and legal remedies are insufficient.
Okay, we both agree on reputation, but that's why many people use a pseudonym, because they've had a bad reputation in the past and they can escape their prior mistakes by using a new nom de plume. And that is at least permissible in the United States. Again, one point that you mentioned is the worst case of all. There are the short sellers who make a very harsh attack, and then a day and a half later, begin to go long. They not only eliminate their short position, they become net long. That's because they expect that they will be factually countered by the company, and you make money both going down and going up. That's the case that I think is most fraudulent, and that's why I would like to force people to have to disclose a change in position, because that means a lot.
I have a comment, going back to, I think it was Hans's question on reversing situation, short selling, to what I think he was referring to maybe as pump and dump, where you promote a stock and you profit and sell before it falls back down. And just my time at the SEC, and back to the difficulty in proving scienter that Professor Coffee was talking about, is that the SEC only ever addresses a fraction of pump and dump fraud risk. And at some point during my tenure there was a distinct shift in the strategy, which is they could spend all their resources going after the bad actors in that market, or they could spend some of the resources towards investor education. And part of the issue was investors reacting to information in ways that perhaps they shouldn't. Now, it's much different a pump and dump than it is some of the short selling activities, but it's also true if you're a long-term investor, a buy and hold investor, then a 2 or 3 day stock change due to perturbation information or reconciling information in markets isn't going to affect your portfolio. So who it affects the most are those who are trading on short frequency and making decisions based on that type of information. So I'm not saying there's a solution here, only a recognition that those that are harmed are a particular segment of the market. And typically buy and hold investors investing for the long term aren't affected by these short price swings.
I follow up with a question from the audience. Anders Andersson, he asks, he says, it seems that many of the problems centered around malicious trading strategies is the legislation lagging behind the market, or can this general problem even be solved?
Just to be clear, what was the question? Was asking whether regulation was behind on what to mention?
Yeah, so around malicious sort of trading strategies and if lagging behind the market and if this can ever be solved.
There are, well, I mean, it opens the discussion, but there are definitely open to other areas, but there are very big problematic unresolved issues in markets related to, for example, something called momentum ignition, where you have predatory traders that try to run the stop loss orders and, you know, force automatic trading and people selling their positions by exerting downward pressure in securities. And there is no regulation that exists right now to prohibit specifically that type of trading behavior. In fact, the SEC had a concept release over a decade ago asking what to do about it, because the enforcement division can't take actions because there is no policy on what is permissible and not in that type of predatory high frequency trading. So it's an open issue. I think it is related to what we're talking about here, because the way you get momentum ignition and selling the downside is by selling securities, and some of those may be shorting versus, you know, owning the stock before selling it. So I do think regulation is lagging on that dimension.
Let me just add a further comment. The person who asked that question is entirely correct, but frankly, regulation always lags behind the market. The question is, how far behind is it? In the United States, we have yet to been able to pass through Congress a definition of insider trading. Something did pass the House this year. It wasn't very good, but it did pass. So I think right now we have a fairly paralyzed legislative body in the United States. You really can't expect that Congress is going to solve these problems. You have to find narrower rules that the SEC can adopt, rules that might require immediate disclosure, rules that, if they could do it, would require a holding period, or rules that would give the agency more flexibility in changing the circuit breaker, moving it up or down, depending on the level of volatility. Those are possible answers, but I'm afraid legislation is the pursuit of the Holy Grail right now.
Just to add that it's not only a question of legislation, but also it's a question of data. Having the trade by trade data and being able to identify who is doing what in the market from the perspective of the regulator is one of the big challenges. So it's I won't expect a solution to that, at least not in the short term, because of the challenges of the legislation itself, but also because of the data requirements.
All right, I have another question. It's for Alexander. In your research, did you look at institutional shareholders' reactions to anonymous activists' short campaigns versus those from well-known names such as Carson Block, etc.?
I mean, not specifically like that, but the cut that we did make was based on the track record of the short seller. So that basically captures the likes of Muddy Waters on the one hand versus the people who are just popping up on an internet message board with a pseudonym for the very first time. And you see very clearly in the data, once you take trading costs into account in particular, and that's the shorting costs that are super high for these stocks, you see that the only short sellers who are making money out of these strategies are the ones who've got a track record of actually being right when they make certain claims. And the internet notice board pseudonym kinds of players, they're not even breaking even after their trading costs. So they might be trying this on for a little while, but sooner or later they're going to run out of cash if they're just making statements. The other thing that we were able to look at was going through these literally hundreds of reports and mining them for whether they were opinion pieces. Like John was saying earlier, I think some companies' accounting standards are not up to scratch, or whether the reports included real scoops, the kinds of things that weren't disclosed, that would surprise an investor in the company, that constitutes new information, which hopefully is credible based on the track record of the short seller. When you cut it that way, opinion piece versus fact, or alleged fact in the reports, you find that the opinion pieces don't move the market. What is moving the market are the kinds of reports that come up with new kinds of facts. So between those two ways of cutting the data, I think we are getting at the kinds of, if you like, muddy waters, to take one example, who do this as a business and do it in a way that's long-term focused and that are very concerned about their reputation and that want to be able to do this going forward. And the fly-by-night operators who do it very occasionally, who are in our sample, but who don't seem to have the market impact, which suggests to me that investors are not necessarily being fooled by them. They're not listening to them, at least in our data.
We are approaching 5 o'clock Stockholm time, and I have several questions from the audience. But what we will do is that we will forward the questions to the panelists so they are aware of the questions and can bring them home, food for thoughts. And we'll stop the panel here, and I let Alexander have some final words.
Okay, for my final words, let me share some slides with you, or not. So what remains to say is just to thank John, Scott, and Pedro for acting on the panel and for letting us try and make some headway on the very thorny issue of how to think about short sale regulation. I think this topic is going to stay with us for a while. It seems to have a frequency of maybe 5-10 years, and it comes and goes. And I think we're right now in a market environment in which we're going to see quite a lot of short selling grabbing the headlines. So we will no doubt come back to these issues. But for the time being, let me thank our panelists and just mention, stay tuned for future events by the Stockholm Dialogue, which will advertise you in due course. Thank you.